There is a number your bank never told you about: $2,500. That number sits quietly inside the fine print of almost every major bank in America. And whether you have more than it or less than it determines whether your bank is working for you or quietly working against you every single month. This is called the $2,500 rule. And today, I am going to show you exactly how banks use this number in 3 different ways to keep your money small, your credit weak, and your financial progress slower than it needs to be. Welcome to CardWise. If you have ever felt like you are doing everything right with money but still not getting ahead, this video is going to explain a big part of why. And more importantly, it is going to show you exactly how to flip each one of these mechanisms in your favor. Let us get into it. Part 1. The minimum balance trap. The first way banks use the $2,500 rule against you starts the moment you open a checking account. Here is what most people do not read carefully when they sign up. Almost every major traditional bank in America, we are talking Bank of America, Chase, Wells Fargo, Citibank, has a monthly maintenance fee built into their standard checking accounts. This fee ranges from $12 to $25 every single month. That is up to $300 per year just to keep your money in their building. Now, here is the part that sounds reasonable on the surface. Most of these banks will waive that monthly fee if you keep a minimum daily balance of $2,500 or more in your account at all times. So the message from your bank is simple. Keep at least $2,500 with us at all times, and we will not charge you. Drop below that number even for one day and the fee kicks in automatically. Think about what this actually means for the average American. According to Federal Reserve data, nearly 40% of Americans cannot cover a $400 emergency expense without borrowing money. For these people who are already living paycheck to paycheck, keeping $2,500 sitting untouched in a checking account is completely unrealistic. So what happens? They get charged $12 to $25 every single month. Month after month, year after year. The people who can least afford to pay bank fees are the ones paying them constantly. And the people who have more than $2,500 sitting in the account never pay a single cent. Your bank has designed a system where poverty costs money and wealth is free. The fix is straightforward, and you can do it today. Stop banking with traditional banks that charge minimum balance fees entirely. In 2026, there is absolutely no reason to pay a monthly fee to store your own money. Online banks like Ally, Marcus by Goldman Sachs, SoFi, and Chime all offer completely free checking accounts with 0 minimum balance requirements and 0 monthly fees. No $2,500 threshold. No penalty for having a low balance. Just free access to your own money. If you are currently paying a monthly maintenance fee to your bank, switch it. The process takes about 15 minutes online, and most banks will even help you transfer your direct deposit automatically. Over 1 year, that switch alone saves you up to $300. Over 5 years, that is $1,500 back in your pocket just from eliminating a fee that should never have existed in the first place. Part 2. The credit approval threshold. The second way the $2,500 rule affects your financial life is one that almost nobody talks about, and it lives inside the credit approval process. When you apply for a credit card or a personal loan, the lender does not just look at your credit score. They look at your entire financial profile. And one of the factors they assess, quietly, without telling you, is your existing available credit across all your current accounts. Here is the specific mechanism. Many lenders use internal risk models that flag applicants whose total available credit across all cards is below $2,500. This is not published anywhere. It is not part of your FICO score. But it influences approval decisions and credit limit offers constantly. Why does low available credit signal risk to a lender? Because it tells them one of 2 things. Either you are new to credit and have not built up limits yet, or you have been maxing out your existing cards, which means your limits are low because issuers do not trust you with more. Either way, when your total available credit sits below $2,500, you are in a category that lenders treat as higher risk, even if your payment history is perfect. This creates a cycle that traps people. Low available credit makes lenders nervous. Nervous lenders offer lower limits. Lower limits mean your utilization goes up faster when you spend normally. Higher utilization drops your score. A lower score leads to more rejections and lower limit offers, and the cycle continues. Here is how you break it. The fastest way to push your total available credit above $2,500 is to request a credit limit increase on your existing cards. You do not need to open a new card to do this. Log into each of your current credit card accounts and request a limit increase directly through the app or website. Most issuers allow you to do this every 6 to 12 months without a hard inquiry, meaning it does not affect your credit score at all. If you have been a consistent on-time payer for at least 6 months on any card, there is a strong chance your issuer will approve an increase. A $200 to $500 increase on 2 or 3 cards can push you past that $2,500 threshold, and the difference in how lenders view your profile is significant. The second strategy is to keep your utilization on each individual card below 10% at all times. A higher available credit limit only helps you if you are not filling it up. Low utilization plus higher available credit is the combination that moves you out of the risk category and into the profile that gets approved for better cards and better rates. Part 3. The Savings Rate Discrimination System. The third way the $2,500 rule works against everyday Americans is the quietest one, and in some ways the most unfair. You already know that keeping money in a traditional savings account earns you almost nothing. The national average savings rate at traditional banks right now sits at around 0.4% annually. That means if you have $1,000 in a traditional savings account for an entire year, you earn $4. $4 for trusting them with your money for 12 months. But here is what most people do not know. Many banks, including online banks that advertise high yields, have tiered interest rate structures. This means the rate you earn on your savings is not the same for everyone. It depends on how much money you have sitting in the account. The threshold where the better rate kicks in is almost always around $2,500 or above. Below that number, you earn the base rate, which at traditional banks is essentially nothing. Above that number, you start accessing the promotional rate that the bank advertises. So when a bank runs a commercial saying earn 5% on your savings, that rate is often only available to people who already have at least $2,500 sitting in the account. People with smaller balances earn a fraction of that. The advertisement is technically accurate, but it is designed for people who already have money, not for people who are trying to build it. This is the savings rate discrimination system, and it quietly means that small savers, the people who need their money to grow the most, are earning the least on every dollar they save. The fix has 2 parts. First, if you do not yet have $2,500 in savings, find a high-yield savings account that offers a strong flat rate with no minimum balance requirement. In 2026, Ally Bank, Marcus by Goldman Sachs, and SoFi all offer competitive rates starting from your very first dollar with no minimum balance threshold. You do not have to wait until you have $2,500 to start earning real interest. Second, make hitting that $2,500 mark a specific financial goal. Not because the banks deserve your loyalty, but because crossing that threshold unlocks better rates, eliminates fees, and removes you from the high-risk category that lenders quietly use against you. $2,500 is the line between the system working against you and the system working for you. Set it as a savings target. Automate a fixed transfer to your high-yield account every payday, even if it is just $50 a week. At that pace, you reach $2,500 in about a year. And once you are past that number, every single mechanism we talked about today starts flipping in your favor instead of against you. Let me bring everything together. The $2,500 rule shows up in 3 places in your financial life. In your checking account, banks charge monthly fees to anyone who cannot maintain that balance, which means the people with the least money pay the most in fees. Fix. Switch to a free online bank today and stop paying to store your own money. In your credit profile, lenders quietly treat total available credit below $2,500 as a risk signal, which traps people in a cycle of lower limits and lower scores. Fix. Request credit limit increases on existing cards and keep utilization below 10% on each one. In your savings account, banks offer their best interest rates only to people who already have $2,500 or more, meaning small savers earn the least on every dollar. Fix. Use a flat-rate high-yield savings account now and make $2,500 your first savings milestone. The bank is not your enemy, but it is a business, and like any business, it has designed its products to benefit people who already have money. Your job is to understand exactly how the system works and then use that knowledge to position yourself on the right side of it. That is what CardWise is here for. If this video helped you, subscribe to CardWise. New videos every week on the credit and finance strategies that put more money back in your pocket. I'm Adam. Thanks for watching. See you in the next one.